Picture this. Somewhere in the world right now, a government official is staring at a spreadsheet. The numbers don't add up. They haven't added up for years. But now, interest rates have doubled, revenues are falling, and the bill is due. This isn't happening in just one country. It's happening in dozens. Welcome to the story of the $300 trillion debt bomb, the greatest financial threat of our generation. A crisis so vast, so interconnected, that when it detonates, no corner of the global economy will be safe. I'm your guide through this financial labyrinth, and over the next 2 hours, we're going to trace the fuse from its origin to the inevitable explosion. We'll identify the victims, predict the casualties, and map out exactly which institutions will fall first when the dominoes begin to tumble. This isn't fear-mongering. This is forensic analysis. By the end of this journey, you'll understand something that most economists are too afraid to say out loud. The system is already breaking. We're just watching it happen in slow motion. Let's start with a number that should terrify you. $300 trillion. That's the total global debt as of 2024 government debt, corporate debt, household debt. It's roughly 3.5 times the entire world's economic output. To put that in perspective, if every human on Earth worked for free for 3.5 years, producing everything we currently produce, we still couldn't pay it off. But here's what makes this different from every other debt crisis in history. We're living in the age of interconnection. When one domino falls, it doesn't just knock over its neighbor. It sends shockwaves through the entire global financial system in milliseconds. And the first domino is already teetering. To understand how we got here, we need to go back to 2008. The global financial crisis taught central banks one lesson. When the economy collapses, print money and drop interest rates to zero. And it worked, sort of. We avoided a second Great Depression. But we also created something far more dangerous, a debt addiction. For 15 years, from 2008 to 2023, money was essentially free. Governments borrowed trillions to fund everything from infrastructure to social programs. Corporations took on massive loans to buy back stock and finance expansion. Developing nations issued bonds to foreign investors at historically low rates. Everyone was feasting at the buffet, and the bill seemed like it would never come. To understand how we got here, we need to go back to 2008. The global financial crisis taught central banks one lesson. When the economy collapses, print money and drop interest rates to zero. And it worked, sort of. We avoided a second Great Depression. But we also created something far more dangerous, a debt addiction. For 15 years, from 2008 to 2023, money was essentially free. Governments borrowed trillions to fund everything from infrastructure to social programs. Corporations took on massive loans to buy back stock and finance expansion. Developing nations issued bonds to foreign investors at historically low rates. Everyone was feasting at the buffet, and the bill seemed like it would never come. This is where our story really begins. Because when interest rates rise, debt becomes expensive. Countries that could easily afford their debt payments at 1% interest suddenly found themselves drowning at 5%. And it's not just about affordability, it's about rollover. Here's something most people don't understand. Sovereign debt doesn't work like your mortgage. Governments don't borrow money and pay it back over 30 years. They issue bonds that mature in 5, 10, or 30 years. And when those bonds mature, they have to borrow new money to pay back the old money. It's a perpetual refinancing machine. And it only works when you can refinance at similar or lower rates. But what happens when rates quintuple overnight? You get what we're about to witness. a cascade of defaults that will make 2008 look like a practice run. Let me give you the three ingredients of this perfect storm. Ingredient 1: emerging market vulnerability. Developing nations borrowed heavily in foreign currencies, mostly US dollars and euros. When you're Argentina or Turkey or Egypt, you can't just print more dollars when you need them. You have to earn them through exports or attract them through investment. But with rates rising in the US and Europe, capital is flooding out of emerging markets and back into safe Western bonds. This creates a vicious cycle. Their currencies collapse, making their dollar-denominated debt even more expensive to service, which causes more capital flight, which crashes their currencies further. We're watching this happen right now in Pakistan, where reserves have fallen so low they can barely afford to import fuel. In Ghana, which defaulted in December 2022. In Sri Lanka, which saw its government collapse entirely. These aren't isolated incidents. They're early warnings. Ingredient 2: fiscal dominance in developed nations. Here's an uncomfortable truth. Western governments can't afford high interest rates either. The United States has $34 trillion in debt. At today's rates, the interest payment alone is approaching $1 trillion per year, more than the entire defense budget. Italy's debt to GDP ratio is 140%. Japan's is over 260%. These countries have a choice. Either cut spending dramatically, raise taxes massively, or force their central banks to start buying bonds again, essentially printing money to finance government spending. The technical term for this is fiscal dominance, when government financing needs override monetary policy goals. And it's the death spiral of currencies throughout history. Ingredient 3: the banking system's hidden exposure. This is where it gets truly dangerous. Banks, especially the largest international banks, are not just holding government bonds. They've lent hundreds of billions to corporations in emerging markets, to real estate developers in China, to commodity traders in Africa and Latin America. When sovereign debt defaults, it triggers corporate defaults. When corporations default, banks take losses. When banks start failing, credit freezes, economies seize up, and governments that were already struggling suddenly face both a banking crisis and a debt crisis simultaneously. This is the cascade we're predicting, and the data suggests it's not a matter of if, it's a matter of when. Now let's get into the mechanics. How exactly does a debt crisis in one country spread to become a global catastrophe? To answer this, we need to think like a network scientist. Imagine the global financial system as a vast web. Every country, every bank, every major corporation is a node in this network. And the connections between them, the loans, the bonds, the trade relationships, the currency swaps, those are the threads. When one node fails, it sends stress rippling through every thread connected to it. Some threads snap immediately. Others stretch and hold for a while. But as more nodes fail, more threads snap, and a load on the remaining connections becomes unbearable. This is cascade failure, and we can model it. Let me walk you through the most likely scenario based on current exposures and vulnerabilities. Stage 1. The emerging market trigger, months 0 to 6. The cascade likely begins with a series of defaults in what I call the fragile 8, the most vulnerable nations right now. The prime candidates: Pakistan, foreign reserves critically low, $130 billion in total debt, IMF bailout barely keeping them afloat, political instability threatening any reform. Egypt, currency under massive pressure, $165 billion in external debt, Gulf support is temporary, reserves down 60% from peak. Tunisia, already in intense IMF negotiations, bond yields above 20%, youth unemployment over 40%. Kenya, facing a bond maturity wall, $70 billion in debt, tax protests threatening government stability. El Salvador, the Bitcoin gamble has failed spectacularly, $30 billion in debt for a tiny economy, dollar debt growing exponentially. Lebanon, already in default since 2020, but the contagion potential remains as restructuring fails. Zambia, copper revenues falling, Chinese loans coming due, infrastructure projects half finished and generating no revenue. Ethiopia, civil conflict, aid withdrawal, debt restructuring stalled, famine conditions in regions. When one of these countries formally defaults, meaning they announce they cannot make their bond payments, several things happen immediately. First, credit default swaps trigger. These are insurance contracts that pay out when a default occurs. The problem? Many banks sold these swaps thinking they'd never have to pay. Suddenly, they're on the hook for billions. The Bank for International Settlements estimates there's over $60 trillion in outstanding credit derivatives. Even a small percentage triggering creates chaos. Second, contagion of fear. Investors don't wait to see which country is next. They pull money from all emerging markets simultaneously. Bond yields spike across Africa, Latin America, and Southeast Asia. We saw this in the taper tantrum of 2013 when the Fed merely hinted at reducing stimulus. Imagine the effect of actual defaults. Third, currency collapses. As capital flees, currencies can drop 30%, 40%, even 50% in a matter of weeks. The Turkish lira fell 44% in 2021 alone. The Sri Lankan rupee dropped over 80% during their crisis. This makes every dollar of debt exponentially more expensive to service. Within 6 months of the first major default, I predict 12 to 15 emerging market nations will be in default or restructuring negotiations. That's not speculation. It's based on debt maturity schedules and reserve levels that are publicly available. Stage 2, the Chinese wildcard, months 6 to 12. Here's where it gets interesting and terrifying. China has been the primary lender to many of these emerging markets through its Belt and Road Initiative. According to research from Boston University's Global Development Policy Center, China has lent over $1.3 trillion to developing nations since 2008. Africa alone has received over $150 billion. When these nations default, China faces an impossible choice. Forgive the debt and take enormous losses that their banking system cannot absorb, or demand repayment and trigger political chaos in countries that now see China as a neo-colonial creditor, destroying China's geopolitical ambitions. But China has its own problems, massive structural problems. The real estate sector, which represents roughly 30% of Chinese GDP, is in free fall. Evergrande defaulted on over $300 billion in liabilities. Country Garden, once China's largest developer, defaulted on $190 billion. Fantasia, Kaisa, Modern Land, Sunac, the list goes on. Over 50 developers have defaulted since 2021. And it's not just developers. Local governments in China relied on land sales for 40% of their revenue. With the property market collapsed, these governments are effectively bankrupt. Total local government debt exceeds $9 trillion, much of it hidden in off-balance sheet vehicles. Chinese banks are sitting on an estimated $3 to $5 trillion in non-performing loans, hidden through accounting tricks, government pressure, and a complete lack of transparency. The actual number could be higher. We simply don't know because Chinese financial reporting is opaque by design. When emerging market defaults hit Chinese banks simultaneously with the domestic real estate crisis, something has to give. The most likely scenario, China imposes strict capital controls, preventing money from leaving the country. They force banks to merge, hiding losses in the consolidation. They may even selectively default on some external obligations while maintaining payments on others to preserve critical relationships. This would be unprecedented for a country of China's size, the world's second largest economy, and would send shockwaves through every Western bank with Chinese exposure. And many Western banks have enormous Chinese exposure. Stage 3. European banks at the breaking point, months 12 to 18. European banks are the weakest link in the Western financial system. Let me be specific about why. Deutsche Bank has approximately $1.3 trillion in total assets and derivatives exposure exceeding $40 trillion in notional value. Yes, you heard that right, $40 trillion. Now, notional value doesn't equal actual risk, but even if actual risk is 1% of notional, we're talking about $400 billion in potential losses. Deutsche Bank has significant emerging market exposure, an estimated $80 billion in direct loans to developing nations and their corporations. They're heavily involved in trade finance across Asia and Africa. They have counterparty relationships with virtually every major Chinese bank. Their stock price tells the story. It's down over 90% from its 2007 peak. The market has been screaming for years that this bank is in trouble. HSBC has $3 trillion in assets, with roughly 40% of revenue coming from Asia. They're the primary Western bank facilitating trade between Asia and the rest of the world. Hong Kong real estate exposure alone exceeds $200 billion. When the Hong Kong property market collapses, and it is collapsing down over 30% from peak, HSBC takes massive hits. Standard Chartered is even more exposed. Over 75% of their business is in Asia, Africa, and the Middle East. They position themselves as the bank of choice for belt and road projects. When those projects fail and those countries default, Standard Chartered's entire business model crumbles. BNP Paribas, Société Générale, and UniCredit all have significant exposure to Eastern European debt, Turkish assets, and North African financing. BNP Paribas has over 60 billion euros in exposure to emerging markets. Société Générale's Russian subsidiary was seized, costing them billions. Imagine that happening in multiple countries simultaneously. Here's the cascading mechanism. Emerging market defaults, Chinese banking stress, European banks report massive losses, credit rating downgrades, stock prices crash, depositors start withdrawing, interbank lending freezes, banks can't fund themselves, they're forced to sell assets at fire sale prices, asset price collapse, mark-to-market losses, capital evaporates, government intervention required. But here's the problem. European governments are already drowning in debt. Italy's debt is 2.8 trillion euros, 140% of GDP. Spain's is 1.5 trillion euros. Greece never really recovered from their last crisis. France is running massive deficits. The European Central Bank faces an impossible choice. Let banks fail and risk a complete financial meltdown, or bail them out and destroy the euro's credibility by essentially printing money to save banks while inflation still runs hot. Stage 4. American exceptionalism meets reality. Months 18 to 24. The United States has one massive advantage. The dollar is still the global reserve currency. When crisis hits, capital often flows to U.S. assets as a safe haven. This is the exorbitant privilege. America can borrow in its own currency, and when the world panics, demand for dollars increases, making U.S. borrowing easier even as crisis deepens elsewhere. But this time might be different. Here's why. U.S. banks aren't innocent bystanders. J.P. Morgan Chase has $3.7 trillion in assets, making it the largest bank in America. They have extensive commodities trading operations, derivatives exposure exceeding $50 trillion notional, and operations in over 100 countries. When emerging markets collapse, commodity prices become wildly volatile. Oil, copper, wheat, everything. JP Morgan's trading desks can absorb some volatility, but not a global cascade. Bank of America has $2.5 trillion in assets, with significant exposure to corporate debt. When the cascade hits, corporate defaults will spike. Companies that relied on emerging market sales, companies that borrowed heavily at low rates and now can't refinance. Companies in industries like airlines and shipping that depend on global trade. Citigroup is the most internationally exposed of the major U.S. banks, operating in over 160 countries. They have significant operations in Mexico, Brazil, and across Asia. Their investment banking division arranged many of the bonds that are now defaulting. When countries default, bondholders sue, and often the banks that arrange the deals are targets. Goldman Sachs and Morgan Stanley face similar issues. They underwrote billions in emerging market debt. They have massive derivatives books, and their prime brokerage services to hedge funds mean they're exposed to those funds' blowups. But the real American vulnerability isn't the big banks directly. It's the shadow banking system. Hedge funds have approximately $4.5 trillion in assets under management globally. Many have been reaching for yield in emerging markets, lending to Chinese real estate companies, buying Turkish bonds at high yields, investing in African infrastructure debt. When defaults cascade, these funds face margin calls. They're forced to sell assets to cover losses. This creates fire sales across all asset classes, not just the failing emerging market bonds, but U.S. stocks, corporate bonds, even treasuries. Private equity firms like Blackstone, KKR, and Carlyle have invested hundreds of billions in emerging market companies. Those investments will be written down to zero in many cases. Pension funds, the retirement savings of millions of Americans, have been desperately seeking returns in a low-rate world. Many allocated 10%, 15%, even 20% of their portfolios to emerging market debt and alternative investments. When those collapse, pension funding ratios crater, requiring massive contributions from state and local governments that are already fiscally stressed. This is exactly what happened in 2008 with mortgage-backed securities, except now it's global and the numbers are far larger. The cascade complete, months 24 to 36. By the 2 to 3 year mark, we're looking at a fundamentally transformed financial system. Multiple sovereign defaults numbering in the dozens. Bank failures requiring hundreds of billions in government bailouts. Central banks printing money on an unprecedented scale while inflation runs hot even as economies contract. Stagflation on steroids. Global trade contracts by 20% to 30%, larger than the Great Depression. Supply chains that took decades to build fragment into regional blocks. Countries that can't pay their debts exit international capital markets for years. forced into autarky. The cascade doesn't end, it transforms. We enter a new phase of financial history, one defined by fragmentation rather than globalization, by capital controls rather than free flow of money, by regional currency blocks rather than dollar dominance. This is the new normal after the cascade, a world fundamentally reshaped by the consequences of $300 trillion in debt finally coming due. Let's get brutally specific. Which institutions are most at risk when this cascade begins? I'm going to rank them by vulnerability, combining their exposure to risky debt with their capital buffers, their funding stability, and their systemic importance. This is the hit list. Tier 1. Critical risk. These institutions face existential threat. Number 1. Deutsche Bank, Germany. Total assets, $1.3 trillion. Derivatives exposure, $40+ trillion notional. Emerging market exposure, estimated $80 billion. Capital ratio, 13.4%, adequate on paper, but stock price, down 91% from 2007 peak. Why they're uniquely vulnerable. Deutsche Bank is the poster child for everything wrong with European banking. They're huge, complex, globally interconnected, and have been bleeding money for years. They paid over $18 billion in fines since 2008 for various scandals. Money laundering, rate manipulation, mis-selling of securities. That's capital that didn't go into their buffer. Their derivatives book is the real nightmare. It's complex, interconnected with every major financial institution globally, and extremely sensitive to counterparty failures. When a cascade starts, counterparty risk explodes. Suddenly, the hedges you thought protected you become worthless because the institution on the other side of the trade can't pay. Deutsche Bank's exposure to emerging markets runs through their corporate and investment banking divisions. They finance commodity traders in Africa, infrastructure projects across Asia, trade finance operations in Latin America. When those regions default, those loans go bad. But here's what makes them Tier 1. Their funding is fragile. Large institutional depositors can pull money overnight. Their stock price reflects market skepticism. If panic starts, depositors will run, and Deutsche Bank could collapse in days. What happens if they fail? The European Central Bank would be forced to intervene within hours. We're talking full nationalization, potential bail-in of creditors, and immediate contagion to other European banks. The interbank lending market would freeze. Banks would stop lending to each other out of fear. Credit across Europe would seize up overnight. The derivatives market would face unprecedented uncertainty. Trillions in notional exposure would suddenly be in question. Hedge funds, pension funds, other banks, they'd all scramble to figure out their actual exposure and try to hedge with whatever counterparties still seemed solvent, driving up hedging costs and potentially triggering margin calls across the system. This is scenario planning material for every central bank in the world. Number 2, Standard Chartered, UK/Hong Kong. Total assets, $800 billion. Geographic focus, 75% Asia, Africa, Middle East. Hong Kong exposure, estimated $150 billion. Emerging market loans, over $200 billion. Why they're vulnerable. Standard Chartered's entire business model is based on serving the trade and capital flows between Asia, Africa, and the Middle East and the rest of the world. They're the primary bank for countless belt and road projects. They've lent heavily to commodity exporters, to corporations in Pakistan, Bangladesh, Vietnam, Kenya, Nigeria. Their Hong Kong exposure is enormous. both direct real estate lending and lending to companies whose value depends on Hong Kong property as collateral. Hong Kong property prices have fallen over 30% from peak and are still falling. That wipes out trillions in collateral value. When emerging markets default and trade finance freezes, Standard Chartered's revenue model collapses. They become essentially a bank without a viable business. What happens if they fail? Trade finance across Asia and Africa grinds to a halt. Companies that depend on letters of credit to ship goods lose access. Supply chains break. The economic contraction in emerging markets accelerates dramatically. The British government would face pressure to bail them out, but Standard Chartered's exposure is primarily overseas. British taxpayers funding Asian losses would be politically explosive. Number 3, Crédit Agricole, France. Total assets, $2.2 trillion, one of Europe's largest. Italian government bond holdings, 50 plus billion euros. Emerging market exposure, 40 plus billion euros. Eastern European operations, significant. Why they're vulnerable. Crédit Agricole is deeply interconnected with Italian sovereign debt. When the Cascade puts pressure on Italian bonds, and it will, Crédit Agricole's balance sheet takes massive hits. Italian 10-year bonds could see yields spike from current levels around 4% to 7%, 8%, even 10% during a crisis. Every percentage point increase represents billions in losses for holders. They're also heavily exposed through their subsidiaries in Eastern Europe, Poland, Ukraine, pre-war, but those losses still exist, Romania. These economies are vulnerable to trade disruptions with both Western Europe and Russia. What happens if they fail? The French government would bail them out. They have no choice. Crédit Agricole is France's largest retail bank, but the bailout would raise serious questions about France's fiscal sustainability. French bond yields would spike, putting pressure on the entire Eurozone. This could trigger the sovereign bank doom loop. Weak banks hurt the government's finances. Weak government finances hurt the banks, spiraling downward. Number 4, HSBC, UK/Hong Kong. Total assets, $3 trillion. Asia revenue, 40% of total. Hong Kong property exposure, $200 plus billion. China operations, extensive. Why they're tier 1, but slightly better positioned. HSBC is better capitalized than Standard Chartered and more diversified than Deutsche Bank. But their exposure to Hong Kong and China is existential. They're trapped between two political systems, the UK and China, and trusted by neither. Hong Kong's property market collapse directly hits their balance sheet. Chinese government pressure to support failing state-owned enterprises creates political risk. If HSBC refuses, they lose access to the Chinese market. If they comply, they take enormous losses. Their saving grace, size and diversification. They have profitable operations outside Asia that can absorb some losses. But make no mistake, a full Asian financial crisis would put HSBC in critical condition. Tier 2, severe stress. They'll survive but suffer dramatically. Number 5, BNP Paribas, France. Better capitalized than Crédit Agricole. More diversified, but still significant emerging market exposure and Eastern European operations. Will require government support, but likely survives in some form. Number 6, Société Générale, France. Similar profile to BNP Paribas, but with weaker capital position and more aggressive trading operations. The Russian subsidiary seizure was a preview of what could happen in multiple countries. Survival likely, but painful restructuring certain. Number 7, UniCredit, Italy. Italy's largest bank, holding massive amounts of Italian government bonds. When Italian yields spike, UniCredit's capital erodes. Survival depends entirely on ECB intervention. Could be nationalized. Number 8, ING Group, Netherlands. Significant emerging market operations, particularly in Turkey. Well capitalized, but not immune. Will take substantial losses, but likely remains independent. Number 9, Citigroup, United States. Most internationally exposed of major U.S. banks. Operations in over 160 countries mean exposure to multiple failing economies. Will remain solvent due to size and U.S. government backing, but faces multi-year earnings depression and potential forced sale of international operations. Number 10, Barclays, UK. Significant investment banking operations and emerging market exposure. Better positioned than European peers, but still facing substantial losses. May require Bank of England support. Tier 3. Painful but manageable. These weather the storm. Number 11. JP Morgan Chase, United States. The strongest major bank globally. Capital ratio above 13%. Diversified revenue streams. Fortress balance sheet. Will take significant losses on international exposure and derivatives volatility, but has sufficient buffer to absorb them. Might actually strengthen relative position by acquiring failed competitors at distressed prices. Exactly what they did with Bear Stearns and Washington Mutual in 2008. Number 12, Bank of America, United States. Primarily domestic focus protects from direct emerging market exposure. Will face losses from corporate defaults and market volatility, but manageable given capital position. U.S. government backing implicit. Number 13, Wells Fargo, United States. Least internationally exposed of major U.S. banks. Primarily domestic retail and commercial banking. Will face domestic recession effects. Higher default rates. Lower lending volumes, but avoids the worst of the cascade. Number 14, Goldman Sachs, United States. Investment bank model means different risk profile. Will face losses from underwriting exposure and trading volatility, but their ability to pivot quickly and reduce risk gives them advantages. Will remain profitable, though earnings will decline substantially. Number 15, Morgan Stanley, United States. Similar to Goldman Sachs. Wealth management operations provide stable revenue. Trading losses will hurt but won't threaten solvency. The Chinese banking black box. Chinese banks deserve special, separate analysis because their true condition is fundamentally opaque. Industrial and Commercial Bank of China, ICBC. $6 trillion in assets. Largest bank in the world. China Construction Bank. $5 trillion in assets. Agricultural Bank of China. $4.8 trillion in assets. Bank of China. $4.2 trillion in assets. Together, these four banks hold over $20 trillion in assets. More than the entire U.S. banking system. They're sitting on enormous belt and road loans that will never be fully repaid. Estimated $400 billion to $600 billion in actual losses hidden through restructuring. Real estate developer debt that's largely worthless. Over $1 trillion in exposure to failed developers. Local government financing vehicle debt. $9 trillion in loans to entities that have no revenue. Fake accounting that vastly overstates asset quality. The Chinese government will not allow these banks to formally fail, it would mean political collapse. Instead, expect forced mergers of weak banks into strong ones, hiding losses in the consolidation. Government capital injections disguised as special purpose vehicles and strategic investments. Accounting flexibility allowing them to hide non-performing loans indefinitely. Capital controls preventing depositors from moving money offshore. Pressure on banks to continue lending to zombie companies to maintain employment. The danger isn't that Chinese banks fail outright. The government won't allow it. The danger is they become zombies, unable to support real economic growth, creating a lost decade or two of stagnation while sitting on trillions in hidden losses. This would remove China as an engine of global growth and eliminate them as a lender to developing nations, accelerating the cascade elsewhere. Shadow banks and non-bank financial institutions. Don't forget the institutions that aren't regulated like banks, but are just as systemically important. Hedge funds. Bridgewater Associates, $140 billion AUM. Macro strategies exposed to currency volatility. Citadel, $60 billion AUM. Market making creates systemic importance. Renaissance Technologies, $130 billion AUM. Quantitative strategies can amplify selling pressure. When hedge funds take losses, they face redemptions. Investors pull money, forcing sales, driving down prices, creating more losses. During the 2008 crisis, over 1,000 hedge funds liquidated. Private equity. Blackstone, $975 billion AUM. Real estate exposure particularly concerning. KKR, $500 billion AUM. Emerging market PE investments will be written down. Carlyle Group, $375 billion AUM. Energy and infrastructure exposure. Private equity has been the beneficiary of cheap money for 15 years. Many of their portfolio companies are heavily leveraged and will struggle to refinance in a high-rate crisis environment. Pension funds. CalPERS, $450 billion. California public employees. Japan GPIF, $1.6 trillion. World's largest pension fund. Teacher Retirement System of Texas, $200 billion. Pension funds need returns of 7% to 8% to meet obligations. In a crisis, they'll be lucky to break even. This creates funding shortfalls requiring massive contributions from governments already under fiscal stress. Insurance companies. AIG, $550 billion assets. Remember 2008? They're back in the derivatives business. Allianz, $1.4 trillion assets. Significant European sovereign debt holdings. AXA, $1.1 trillion assets. Exposure through insurance and asset management. Insurance companies sold protection on various debt instruments through credit default swaps and other derivatives. When cascading defaults occur, they face enormous claims. AIG nearly destroyed the global financial system in 2008 when they couldn't pay their CDS claims. The risk remains today. Understanding who is exposed is important. But understanding how the contagion spreads, the actual mechanisms by which a default in Pakistan becomes a crisis in Paris or New York, that's critical if you want to see it coming. Let me explain the 7 transmission mechanisms that turn a local crisis into a global catastrophe. Think of these as the 7 horsemen of financial apocalypse. Mechanism 1, direct credit exposure, the obvious path. This is the simplest path, and in some ways, the least dangerous because it's transparent. Bank A lends $10 billion to country B. Country B defaults. Bank A takes a $10 billion loss. If Bank A has $100 billion in capital, they can absorb it painfully but survivable. Their stock price drops, maybe 20% or 30%. Investors are unhappy. Executives lose bonuses, but the bank continues operating. But here's where it becomes contagious. That $10 billion loss drops Bank A's capital ratio below regulatory minimums. Regulators force them to shrink their balance sheet. They call in loans to other borrowers, corporations, other banks, maybe even other countries. They stop making new loans entirely. They sell assets at whatever price they can get, often far below fair value. Those borrowers who got their loans called, now they're in distress. The corporation that was borrowing to finance inventory suddenly can't pay suppliers. The suppliers default on their loans. The bank that lent to the suppliers takes losses. And those assets Bank A dumped at fire sale prices, those set new market prices. Other banks holding similar assets have to market, adjust the value of their holdings down to match market prices even though they haven't sold. This creates paper losses that erode their capital, forcing them to shrink too. One $10 billion default becomes $50 billion in losses across the system through forced deleveraging and asset price declines. Mechanism 2. Derivatives and counterparty risk, where complexity becomes catastrophe. This is where financial engineering creates systemic fragility. Modern banks don't just lend money. They make complex bets with each other using derivatives. The global derivatives market has notional value exceeding $600 trillion. Now, notional value overstates actual risk dramatically. It's like saying everyone who bought car insurance is exposed to the full value of their car. But even a small percentage of that represents catastrophic risk. Let me give you a concrete example of how this spreads. Bank A bought credit default swaps from insurance company B to protect against defaults on bonds from country C. Country C defaults. Insurance company B owes Bank A $5 billion. But insurance company B doesn't have $5 billion. They sold protection on hundreds of different bonds, thinking they'd never all default at once. Insurance company B fails. Now Bank A, who thought they were protected, realizes their hedge is worthless. Their actual losses are twice what they expected. Their capital is devastated. They fail, but doesn't stop there. Bank A had sold credit default swaps to hedge fund C. Hedge fund C was counting on Bank A to pay if certain bonds defaulted. Now Bank A has failed, so hedge fund C's protection is worthless. They take enormous losses. Investors redeem their money from hedge fund C. The hedge fund has to sell everything, stocks, bonds, commodities, to meet redemptions. This forced selling crashes prices across all asset classes. Other hedge funds holding similar positions take losses, face redemptions, sell everything, prices fall further. This is what nearly destroyed AIG in 2008. They'd sold $500 billion in credit default swaps, thinking housing prices would never fall nationally. When they did, AIG couldn't pay all the claims. The U.S. government had to bail them out with $182 billion because AIG's failure would have brought down Goldman Sachs, Morgan Stanley, and dozens of other institutions. Today's derivatives market is even larger and more complex. Mechanism 3. Currency collapse feedback loops, the death spiral. This mechanism has destroyed dozens of countries throughout history, and it's about to destroy dozens more. Here's how the death spiral works. Country X has borrowed $50 billion in US dollars. They have to make $5 billion in interest payments this year. To make those payments, they need to buy dollars with their own currency. But when investors get nervous about country X, they start selling country X's currency and buying dollars. The exchange rate moves against country X. Suddenly, instead of needing 50 billion of their currency to buy $5 billion, they need 60 billion, then 70 billion, then 100 billion. This forces country X's central bank to sell their dollar reserves to defend the currency. Reserves fall. Investors see reserves falling and panic more, selling more currency. The currency collapses further. Now country X needs even more of their currency to service dollar debt. Eventually, reserves run out entirely. The currency goes into free fall. 30%, 40%, 50% declines in weeks. The government has a choice: default on dollar debt or completely destroy the currency trying to pay it. Most choose default, which triggers mechanism 1 and 2. But here's where it becomes contagious. When one emerging market currency collapses, investors don't carefully analyze which other countries are different. They panic sell all emerging market currencies simultaneously. This is called contagion through investor behavior. Countries that were perfectly solvent suddenly face capital flight just because they're in the same category as the failing country. Their currencies weaken, their debt service costs rise, and they're pulled into the same death spiral. Thailand's crisis in 1997 spread to Indonesia, South Korea, Malaysia, the Philippines, not because they all had the same problems, but because they were all Asian emerging markets and investors fled them all indiscriminately. When Pakistan or Egypt collapses, expect the same pattern across Africa, Latin America, and Southeast Asia. Mechanism 4. The confidence collapse, banking's Achilles heel. Banking is fundamentally based on confidence and operates on fractional reserves. Your bank doesn't actually have your money sitting in a vault. If you deposited $10,000, they lend out $9,000 and kept $1,000 in reserves. They're counting on the fact that not everyone will ask for their money back at the same time. But confidence is fragile. When people lose confidence, they do all ask at once. This is a bank run. Silicon Valley Bank had $200 billion in deposits on March 8th, 2023. By March 10th, $42 billion had been withdrawn, mostly electronically, in the span of a few hours. The bank couldn't sell assets fast enough to meet withdrawals. They were forced to sell bonds at huge losses, which wiped out capital, and they collapsed. SVB wasn't insolvent in a fundamental sense. Their assets were worth more than their liabilities if they could hold to maturity. But confidence collapsed, and they died in 48 hours. Now imagine that happening simultaneously across dozens of banks in multiple countries. The system can't handle it. Governments have to freeze withdrawals, close banks, impose capital controls. But closing banks to stop runs only increases panic. If people can't access their money, they assume the bank is truly insolvent. When banks reopen, the run intensifies. This mechanism nearly destroyed the global banking system in 1931 during the Great Depression. Bank failures triggered runs on other banks, which failed, triggering more runs. Over 9,000 American banks failed in the early 1930s. The difference today, electronic banking means runs happen at digital speed. In 1931, you had to physically go to the bank to withdraw cash. Today, you can move millions with a phone. A bank can be destroyed before regulators even know what's happening. Mechanism 5. The margin call death spiral. Leverage unwinds. This mechanism nearly destroyed the global financial system in 2008. and it's primed to do so again. Here's how it works. Investment funds borrow money to amplify returns. This is leverage. A hedge fund with $1 billion in investor money might borrow another $3 billion, giving them $4 billion to invest. If they make 10% returns, that's $400 million on $1 billion of actual capital, 40% returns. Leverage amplifies gains, but also amplifies losses. They put up collateral to secure those loans, typically bonds or stocks they own. When asset prices fall, the value of their collateral drops. Lenders demand more collateral to secure the loans. This is a margin call. To meet the margin call, funds have to sell assets. But when everyone faces margin calls simultaneously, everyone is selling. Prices collapse, not because the assets are fundamentally worthless, but because of forced selling. This triggers more margin calls, more forced selling, more price declines. The death spiral accelerates. In September 2008, high-quality corporate bonds fell 30% to 40% in a matter of weeks, even though the companies issuing them weren't failing. The price declines were purely forced selling from leveraged funds facing margin calls. Money market funds broke the buck, meaning they couldn't return 100 cents per dollar to investors. These were supposed to be cash equivalent safe assets. Panic became total. The Federal Reserve had to provide over $1 trillion in emergency lending to stop the spiral. Today, leverage in the financial system is even higher than 2008. Hedge funds are leveraged. Private equity funds use leverage to buy companies. Even safe institutional investors like pension funds use leverage to amplify returns in a low-yield world. When emerging market defaults trigger margin calls across the system, we'll see the same death spiral, but larger and faster. Mechanism 6. Trade finance freezing. Financial crisis becomes economic crisis. This is the mechanism that turns a financial crisis into a real economy depression. Global trade depends on credit. When a Vietnamese manufacturer ships goods to a German retailer, they need payment guarantees. The retailer might pay in 90 days, but the manufacturer needs cash now to pay workers and buy materials. Banks provide this through letters of credit, essentially guaranteeing that the manufacturer will get paid. The bank charges a fee for this service. When banks are stressed, they stop issuing letters of credit. It's too risky. They need to preserve capital. Without letters of credit, trade stops. The manufacturer won't ship goods without payment guarantees. The retailer can't get inventory. Stores run out of products. Manufacturing stops because they can't get parts. In 2008, trade finance availability dropped by 50% in some markets. Global trade fell 12% in 2009, the largest peacetime collapse in modern history. The decline wasn't because people suddenly wanted fewer things or because factories couldn't produce. It was because the financial plumbing stopped working. During the coming Cascade, trade finance will freeze again, but potentially worse because the crisis is more geographically dispersed. Banks will be terrified to guarantee payments from or to countries in crisis. Global supply chains that took decades to build will fragment. Companies will be forced to source locally or regionally, even at much higher costs. Efficiency gains from globalization will reverse. This turns financial crisis into prolonged economic depression. Even after banks are stabilized, rebuilding trade finance takes years. Mechanism 7. The sovereign bank doom loop, when government and banking crises merge. This is Europe's special nightmare, but can happen anywhere. The doom loop works like this. Banks hold large amounts of government bonds. They're supposed to be safe assets required for regulatory capital. But when governments get into fiscal trouble, those bonds lose value. When bond prices fall, banks take losses on their holdings. This weakens banks. Weak banks can't lend to businesses. Economic growth slows. Tax revenues fall. Government deficits widen. Bond prices fall further. Meanwhile, weak banks are at risk of failing. Governments feel obligated to bail them out. They can't let the banking system collapse. But bailouts cost money, increasing government debt. Government finances worsen. Bond prices fall more. The loop spirals. Weak banks hurt government finances. Weak government finances hurt banks, each feeding on the other in a doom loop. Greece, Ireland, Spain, Portugal, and Italy all experienced versions of this in the European debt crisis of 2010 to 2012. Only Mario Draghi's famous promise to do whatever it takes to save the euro stopped the spiral. Essentially a commitment that the ECB would buy unlimited amounts of government bonds if necessary. But conditions are different now. Debt levels are far higher. Inflation is a concern, limiting how much money central banks can print. Political unity in Europe is weaker. Whatever it takes might not be politically or economically possible this time. When the Cascade hits, multiple European countries will face this doom loop simultaneously. Italy's debt to GDP is 140%. Spain is at 120%. France is approaching 120%. All of them have banks holding large amounts of domestic government debt. If Italian bonds collapse, Italian banks collapse. If the Italian government tries to bail out banks, Italian bonds collapse further. If the ECB bails out Italy, German voters revolt and European political unity shatters. There may be no solution that preserves both the banks and the political union. If you've been paying attention, you're probably asking, is this happening now? Are we already in the cascade? How can I see it coming? The answer is, we're in the early stages, the yellow alert phase, and yes, you could track it in real time if you know what to watch. I'm going to give you the dashboard of doom. 8 specific indicators you can monitor to track the cascade's progress. Some are available for free online. Some require a Bloomberg terminal or financial data subscription. But together, they paint a clear picture. Indicator 1. Emerging market bond yields. Your canary in the coal mine. This is your early warning system, and it's screaming already. Government bonds trade every day on international markets. Their yields reflect investor perception of risk. Higher yields mean higher risk of default. Investors demand more compensation for lending to risky borrowers. Here are the critical thresholds. Below 10%. Country is considered investment grade or close to it. 10% to 15%. Junk status, significant risk. 15% to 25%. Default risk, very high. Above 25%. Default almost certain. Investors have given up. Watch these countries specifically. Pakistan. 5-year bonds are trading around 18% to 20% when available. Foreign reserves are under $8 billion, enough for barely 2 months of imports. IMF program keeps them barely alive, but political instability threatens any reform. One political crisis away from default. Egypt. Bond yields spiking to 15% to 18% on longer maturities. Currency devalued over 50% in the past year. They're surviving on Saudi, UAE, and IMF support, but that support is conditional and temporary. Kenya. Eurobonds yielding 12% to 15%. Tax protests in 2024 forced government to abandon revenue measures, creating fiscal crisis. Debt service consuming 60% of tax revenue. Unsustainable. Tunisia. Bonds trading at 20% plus. IMF negotiations stalled over political resistance to reforms. Foreign reserves critically low. El Salvador. Bitcoin experiment failed. Dollar bonds yielding 25% plus. Default probability over 50% in next 2 years, according to credit markets. If you have access to bond data, websites like tradingeconomics.com or investing.com offer some free data. Check these yields weekly. When you see spikes of 5% or more in a week, panic is setting in. When yields cross 25%, default is imminent. Indicator 2. Currency volatility and reserves, the stress test. Currencies don't collapse smoothly. They crash in stages with brief stabilization periods between collapses. Track exchange rates against the US dollar for vulnerable currencies. Pakistani rupee was around 180 per dollar in early 2022, now over 280. Watch for breaks above 300. That signals complete loss of control. Egyptian pound was 15.6 per dollar before recent devaluations, now over 30. The central bank is fighting to prevent further collapse, but reserves are dwindling. Turkish lira. Erdogan's economic policies have been catastrophic. Lira fell from 7 per dollar in 2020 to over 34 today. Watch for acceleration above 40. Argentine peso. Chronic mismanagement. Official rate over 350 per dollar. Black market much higher. New government promising reform, but history suggests otherwise. Nigerian naira was 380 per dollar, now over 800 after currency float. Watch for breaks above 1,000. The key metric isn't just the exchange rate, it's the volatility. When a currency moves 10% in a week, that's crisis mode. When it moves 20%, capital controls or default are imminent. Pair this with reserve data. Central banks publish reserve levels monthly. Watch for declines of 20% or more from peak. Reserves falling below 3 months of import cover. Sharp drops in a single month indicates heavy intervention to defend currency. The Bank for International Settlements publishes reserve data. You can also find it on central bank websites or Trading Economics. Indicator 3. Bank stock prices, the market's verdict. Stock markets are forward-looking. Bank stocks often crash weeks or months before formal announcements of problems. Watch the stock prices of vulnerable banks I identified earlier. Deutsche Bank, ticker DBK, currently around 12 to 15 euros. Watch for breaks below 10 euros. That's panic territory. The stock has crashed multiple times before recovering slightly, but each recovery has been weaker. Credit Agricole, ticker ACA, around 12 to 14 euros. Watch for breaks below 10 euros. Any French bank crash threatens the entire European system. Standard Chartered, ticker STAN, around 6 to 7 pounds. Watch for breaks below 5 pounds. Their entire business model depends on emerging market health. HSBC, ticker HSBA, around 6 to 7 pounds. Better capitalized, but heavily exposed to Hong Kong and China. Watch for breaks below 5 pounds. For U.S. banks, watch Citigroup, ticker C, around $60 to $65. Most internationally exposed. Watch for breaks below $50. The key pattern to watch, accelerating declines. A 10% drop might be normal volatility. A 20% drop in a week signals serious problems. A 40% drop in a month means the market believes failure is possible. Also, watch bank credit default swap spreads. These are like insurance premiums against default. You'll need Bloomberg or a financial data service for this. But CDS spreads are the most sensitive real-time indicator of market fear. For banks, under 100 basis points, normal conditions. 100 to 300 basis points, market getting nervous. 300 to 600 basis points, survival in serious question. Above 600, market pricing in high probability of failure. Deutsche Bank's CDS has traded above 200 basis points repeatedly, a sign of persistent market skepticism. Indicator 4. Interbank lending rates, the trust barometer. Banks lend to each other constantly every single night. They have to. Some banks have extra cash, others need short-term funding. This interbank lending is the circulatory system of the financial system. The rate they charge each other reflects trust. When banks trust each other, rates are low. When trust evaporates, rates spike. The key rates to watch. SOFR, secured overnight financing rate, replaced LIBOR in the U.S. Normally tracks close to the Federal Reserve's target rate, currently around 5.3%. Watch for spikes above 6%. That indicates stress in overnight funding markets. Euribor, Euro Interbank Offered Rate, the European equivalent, currently around 3.5%. Watch for spikes above 4.5%. The spread between these rates and government bond yields. When this spread widens dramatically, it means banks don't trust each other even though government bonds are considered safe. In 2008, this spread blew out to over 300 basis points. You can find this data free on Federal Reserve and ECB websites or on financial news sites. The magic number. If overnight lending rates spike 100 basis points or more in a day or two, credit markets are freezing. That's your signal that interbank trust has collapsed. Indicator 5, corporate junk bond yields, the risk appetite gauge. High-yield corporate bonds, rated BB and below, often called junk bonds, are extremely sensitive to credit conditions and risk appetite. In normal times, junk bonds yield about 4% to 6% more than government bonds of similar maturity. This is called the credit spread. When investors get scared, credit spreads widen dramatically. In crisis, junk bond spreads can hit 10%, 12%, even 15% above government bonds. Watch the ICB of a U.S. High Yield Index or similar. You can find this data on FRED, Federal Reserve Economic Data, or financial news sites. Critical thresholds. Spread below 4%. Markets complacent, possibly too much risk-taking. Spread 4 to 6%. Normal conditions. Spread 6 to 8%. Markets nervous, flight to quality beginning. Spread 8 to 10%. Credit stress, access to funding difficult for risky companies. Spread above 10%. Credit markets effectively closed, financial crisis conditions. In 2008, this spread peaked at over 20%. We're currently around 3% to 4%, relatively complacent. When the cascade hits, watch this spread explode. Indicator 6. Central bank emergency actions, the fear indicator. Central banks telegraph their panic through their actions. They try to be calm publicly, but their emergency measures reveal true fear. Watch for unscheduled emergency meetings. Central banks normally meet on preset schedules. Emergency meetings mean something broke. Currency swap lines activated. This is when the Federal Reserve agrees to provide dollars to foreign central banks in exchange for their currency. It means those countries are running out of dollars. The Fed activated these extensively in 2008 and 2020. When they're activated during the Cascade, it means dollar shortages are critical. New lending facilities, creative names like Term Asset-Backed Securities Loan Facility or Bank Term Funding Program. These are emergency lending programs. Each one represents a part of the financial system that stopped functioning normally. Regulatory forbearance. Watch for statements like temporarily relaxing capital requirements or providing flexibility in asset classification. This means regulators know banks are in trouble and are allowing them to hide it. The Federal Reserve's website publishes all their actions. The ECB, Bank of England, and Bank of Japan do the same. Check them weekly during stress periods. When you see multiple emergency actions announced in a short period, that's your signal. The cascade is accelerating and central banks are in full crisis mode. Indicator 7, Deposit Flight Data, the ultimate bank run indicator. This is perhaps the most important indicator, but also the hardest to track in real time because banks only report it quarterly. Banks publish deposit levels in their quarterly earnings reports. When you see quarter-over-quarter deposit declines of 10% or more in major banks, depositors are running. The pattern typically goes: 1. Regional banks show stress first. 2. Money flows to larger, too big to fail banks perceived as safer. 3. If crisis deepens, even the largest banks see deposit flight as people move to cash or government securities. Silicon Valley Bank lost 25% of deposits in 48 hours before collapsing. That's extreme, but it shows how fast modern bank runs can move. Check quarterly earnings reports from the banks I listed earlier. The key metric is total deposits and the quarter-over-quarter change. Also watch for banks offering unusually high interest rates on deposits. That's often a sign they're desperate to attract funding. Indicator 8, Composite Stress Indicators, the big picture. Several institutions publish composite financial stress indices that combine multiple indicators. St. Louis Federal Reserve Financial Stress Index combines 18 indicators into one index. When it goes above 0, financial stress is elevated. When it goes above 2, crisis conditions exist. Free on Fred website. Kansas City Financial Stress Index. Similar, focused on different indicators. Also free on Fred. ECB Composite Indicator of Systemic Stress, CSS. The European version, tracking stress in European financial markets. These composite indices are useful because they do the work of combining multiple signals. In 2008, these indices spiked to historic highs. In March 2020, during COVID panic, they spiked again briefly. In March 2023, after SVB collapsed, they jumped. When the cascade begins, watch these indices explode. Above 2, on the St. Louis Fed Index, means systemic financial stress. Above 4 means full-blown crisis. The composite picture and current status. So where are we now? At the end of 2024, early 2025? Let me give you the current scorecard. Emerging market bonds. Several countries showing yields in danger zone, 18% plus. Currency volatility. Multiple currencies under severe stress. Recent sharp devaluations. Bank stocks. Volatile but not yet in crash mode. Deutsche Bank. Standard Chartered showing persistent weakness. Interbank lending. Elevated but functioning. No spike yet. Junk bond spreads. Still relatively calm. Around 3 to 4%, but starting to widen. Central bank actions. On edge, some emergency measures post SVB, but not full crisis mode yet. Deposit flight. Some regional stress, but major banks stable so far. Stress indices. Elevated but not crisis levels. We're in what I call yellow alert. No longer green, normal, but not yet red crisis. Multiple indicators are flashing warning signs, but we haven't seen the cascade trigger yet. The transition from yellow to red typically happens very quickly, often over just a few weeks. When one major emerging market formally defaults, when one systemically important bank fails, or when a major currency collapses, all these indicators will flash red simultaneously. That's when you know the cascade is here. And from that point, events move very fast, faster than policymakers can respond, faster than most people can protect themselves. Which brings us to the critical question: why can't governments and central banks just stop this? Now we address the elephant in the room. Can't governments just fix this? After all, in 2008 they did. Massive bailouts, quantitative easing, coordinated central bank action. The system survived. Why won't that playbook work this time? Let me explain why we're in a policy trap, a situation where all available options have devastating consequences. Trap 1. The debt is too large to bail out. In 2008, U.S. government debt was about $10 trillion, roughly 60% of GDP. Total bailout costs, including TARP, Federal Reserve lending, and other programs, came to about $2 to $3 trillion all in. Painful, but manageable. The U.S. could absorb it. Today, U.S. debt is $34 trillion, approaching 130% of GDP. European debt ratios are similar or worse. Italy 140%, France 120%, Spain 115%. Japan is over 260%. There's simply no fiscal space for another multi-trillion-dollar bailout without triggering a sovereign debt crisis in the countries doing the bailing. Think about it. Imagine the U.S. announcing it needs to borrow another $5 trillion to bail out banks. What happens? Treasury yields spike. Investors start questioning whether the U.S. can actually service all this debt. Foreign buyers of U.S. treasuries, China, Japan, Saudi Arabia, get nervous and reduce purchases. The Fed might have to buy the bonds with printed money, but that raises inflation fears. Higher treasury yields mean higher yields on everything else: mortgages, corporate bonds, municipal bonds. The cost of capital spikes across the economy, making the financial crisis worse, not better. It's a trap. You need massive intervention to save the financial system, but massive intervention destroys confidence in government finances, which crashes the bond market, which makes the financial crisis worse anyway. European governments face an even worse version of this trap. They can't print euros individually. Only the ECB can. So countries like Italy or Spain borrowing trillions to bail out banks would likely trigger sovereign bond crises. Bond yields would spike, making their existing debt unsustainable, creating the sovereign bank doom loop. The harsh reality: the system is too big and too leveraged to be bailed out without destroying government credit. Trap 2. Political legitimacy is exhausted. In 2008, the public was angry about bailouts, but governments could still push them through. There were protests, political consequences, but the bailouts happened. Today is fundamentally different. We've had 15 years of quantitative easing that inflated asset prices, primarily benefiting the wealthy. Near zero rates that destroyed returns for savers while enriching borrowers. Corporate bailouts during COVID while small businesses failed. Inflation that destroyed purchasing power, hitting the middle and working class hardest, widening wealth inequality to levels not seen since the Gilded Age. There's no political capital left for bank bailouts. Try telling a voter who lost 20% of their purchasing power to inflation, who's struggling to afford rent or food, who watched their retirement savings earn nothing for a decade while billionaires got richer. Try telling them they now need to bail out banks that paid executives eight-figure bonuses. You'll spark riots. We're already seeing this play out. The backlash to SVB's bailout in March 2023 was instant and furious, even though it was relatively small. Imagine that multiplied across dozens of institutions in multiple countries. Some governments will try anyway. They'll argue systemic necessity, that letting banks fail would be worse. And they might be right economically, but politically it's toxic. Other governments will hesitate, prioritizing political survival over financial stability. Banks will fail while politicians debate. By the time they decide to act, the crisis will have metastasized beyond control. Either way, quick bailouts or hesitant response. The outcome is political chaos layered on top of financial crisis. In Europe, this could literally tear apart the European Union. Northern European voters will refuse to bail out Southern European banks. Southern Europeans will refuse austerity imposed as conditions for support. The euro could fracture. In the U.S., political polarization means gridlock. Remember the 2008 TARP vote? It failed the first time in the House before eventually passing. Imagine that happening while banks are actively failing. Trap 3. Central banks already used their ammunition. Central bank balance sheets exploded after 2008 and again during COVID. The Federal Reserve's balance sheet went from $900 billion in 2008 to a peak of nearly $9 trillion in 2022. The ECB went from 1 trillion euros to over 8 trillion euros. Bank of Japan from 100 trillion yen to over 700 trillion yen. They bought government bonds, mortgage-backed securities, even corporate bonds. They pushed interest rates to zero or negative. They did whatever it takes. And it worked it prevented deflation and depression, but it also created massive side effects. Asset bubbles in stocks, bonds, and real estate. Zombie companies kept alive by cheap credit. Addiction to low rates across the economy. And most critically, an inability to fight inflation when it returned. Starting in 2022, central banks had to reverse course. They raised rates aggressively, the fastest hiking cycle in 40 years. They're trying to shrink their balance sheets through quantitative tightening, letting bonds mature without reinvestment. Now, to fight the cascade, they need to completely reverse again. Rates back to zero, massive new asset purchases, balance sheets exploding to $15 trillion, $20 trillion or more. The policy whiplash would be catastrophic for credibility. Markets would assume central banks have no idea what they're doing. If they couldn't control inflation before, why trust them now? But here's the deeper problem. There's a limit to how much central banks can buy before they own the entire bond market, before they've essentially nationalized credit allocation, before the currency loses all credibility. Japan has arguably hit this limit already. The BOJ owns over 50% of all Japanese government bonds. They're trapped. They can't stop buying without crashing the bond market. But continuing to buy means they're simply financing government spending with printed money. The Fed and ECB are approaching similar traps. Trap 4, the inflation monster. This is perhaps the biggest constraint and the most different from 2008. In 2008, the big fear was deflation, prices falling, economic depression, a downward spiral. So printing money and slashing rates was clearly the right response. There was no inflation risk when the economy was collapsing. Today, we're in a completely different situation. Inflation hit 9% in the US in 2022, over 10% in the Eurozone, 20% plus in many emerging markets. Central banks spent 2 years fighting it with rate hikes. If they respond to the cascade with massive money printing, they risk reigniting the inflation they just spent years fighting. You can't simultaneously fight inflation and bail out the financial system with printed money. You have to choose. Choose financial stability, print money, buy bonds, inject capital into banks. Result, inflation roars back, possibly higher than before. You save the banks, but destroy the currency. Choose price stability. Let insolvent banks fail. Let debt defaults cascade through the system. Accept a severe recession or depression. Result, financial crisis, economic collapse, but eventually you preserve currency value. There is no option that preserves both. Most likely outcome, governments and central banks choose inflation over financial collapse. They'll print money, bail out banks, and accept that inflation will return to 10%, 15%, maybe even 20% in some countries. This is what's called fiscal dominance, when government financing needs determine monetary policy rather than central banks independently controlling inflation. It's how currencies die throughout history. Weimar Germany, Zimbabwe, Argentina, Venezuela, they all chose to print rather than default. It works in the sense that you avoid immediate financial collapse. But you trade immediate crisis for long-term currency destruction and chronic high inflation. Some economists argue this is inevitable given debt levels, that the only way out is inflation that reduces the real value of debt. Maybe they're right, but if so, we should be honest. The choice is between financial apocalypse and monetary debasement. There is no good option. Trap 5, international coordination has broken down. In 2008, the G7 and G20 coordinated their responses. Central bank governors worked together, holding conference calls, sharing information, establishing currency swap lines. There was a shared understanding that the global financial system was interconnected and everyone would benefit from coordinated action. That unity has shattered. U.S.-China relations are adversarial. Strategic competition over technology, Taiwan, economic dominance has destroyed trust. When crisis hits, expect accusations that the other side caused it or is exploiting it. Russia is completely isolated from Western financial systems due to Ukraine sanctions. But Russian default or financial crisis could still spread through energy markets, commodities, and the many countries that depend on Russian financing or trade. Europe is internally divided. Northern countries refuse to support southern countries without harsh conditions. Italy and France increasingly question whether the euro is worth the constraints. Populist movements in multiple countries oppose more EU integration. Emerging markets feel abandoned. They see Western rate hikes destroying their economies while Western banks get bailouts. Many are turning to China, to regional cooperation, to de-dollarization efforts. When a cascade hits, expect competitive devaluations. Countries will try to boost exports by weakening currencies. But if everyone devalues simultaneously, it just creates chaos without helping anyone. Capital controls. Countries will prevent money from leaving. Exactly what China is likely to do, what many emerging markets have done historically. This fragments global capital markets, trade barriers. Protectionism will increase as countries try to secure critical supplies. Export bans on food, energy, strategic materials. Finger pointing. China will blame the Fed for raising rates. The US will blame China for belt and road failures. Europe will blame both. Everyone will blame speculators and hedge funds. Without coordination, each country's individual response will be less effective, possibly counterproductive. Currency swaps might not be established quickly enough. Coordinated rate cuts might not happen. Banks could fail because foreign central banks refuse to provide emergency dollar funding. The global financial system was built on the assumption of cooperation. When cooperation breaks down, the system becomes far more fragile. Trap 6. Shadow banking has grown beyond control. Regulators spent 15 years after 2008 making traditional banks safer. Higher capital requirements, stress tests, resolution plans, restrictions on proprietary trading. Traditional banks are probably more resilient now than in 2008 in some ways. But all that regulation pushed risk into the shadows. Hedge funds, private equity, pension funds, insurance companies, money market funds, the shadow banking system has grown massively. Total assets in shadow banking globally exceed $200 trillion, more than the traditional banking system. These institutions aren't subject to the same regulations. They don't have FDIC insurance. Many are highly leveraged. They're interconnected with traditional banks through derivatives and lending relationships. When the cascade hits, shadow banks will face massive stress. Hedge funds will blow up. Private equity funds will see portfolio companies fail. Pension funds will face huge losses. But here's the trap. Should governments bail out hedge funds? Private equity? These are vehicles for wealthy investors and institutions, not ordinary depositors. Politically, it's impossible. But economically, letting them fail could crash the entire system because they're so interconnected with traditional banks. AIG was technically an insurance company, not a bank. But the government had to bail them out with $182 billion because their failure would have destroyed Goldman Sachs, Morgan Stanley, and others. The same logic applies to large hedge funds and shadow banks today. But after 2008's bailout backlash, will governments do it again? Can they afford to? Can they afford not to? There's no good answer, which is why it's a trap. Trap 7. The timing trap, too slow then too fast. Financial crises have a characteristic pattern. They develop slowly, then accelerate suddenly, then move faster than policy can respond. The 2008 crisis was building for years. Subprime lending started deteriorating in 2006. Bear Stearns hedge funds failed in mid-2007. Northern Rock failed in September 2007. But the acute crisis, Lehman, AIG, money markets breaking, global panic, all happened in September 2008, over about 2 weeks. Policymakers are always behind the curve. They wait to see if problems resolve on their own. They fear overreacting. They need political cover before taking dramatic action. By the time they decide to act, the crisis has accelerated beyond control. During the cascade, this timing trap will be brutal. Early warnings will be ignored or dismissed. When crisis becomes undeniable, governments will announce task forces and study groups. While they study, banks will fail. Emergency measures will be announced, but won't be enough. Crisis accelerates faster than policy can adapt. Eventually, measures drastic enough to matter are implemented, but enormous damage has already occurred. This isn't a criticism of policymakers. It's the nature of democratic systems responding to fast moving financial crises. By the time consensus is built for action, the optimal moment has passed. The ultimate policy dilemma. All these traps create an ultimate dilemma. Do nothing, and the financial system collapses. Do too little, and it collapses anyway while you waste resources. Do enough to stop the collapse, and you destroy government finances, reignite inflation, and create moral hazard for the next crisis. Do too much, and you nationalize the financial system, destroy capital markets, and create a zombie economy that can't grow. There is no right answer that preserves everything. Something has to give. The only question is what breaks. Banks, currencies, government bonds, or all three. My prediction: they'll choose to save banks at the expense of currencies. Massive money printing, bailouts, and the return of high inflation. Not 1970s style stagflation. Something worse because debt levels are far higher. But before we get to that endgame, we need to understand what the world looks like after the Cascade. Let's assume we're 2 to 3 years into the Cascade. Multiple sovereign defaults have occurred. Several banks have failed or been bailed out. Central banks are printing money at unprecedented rates. Inflation is running at 10% to 15% in developed nations, much higher in emerging markets. What does the world actually look like? Let me paint the picture across 7 dimensions. Dimension 1, the financial system, smaller, safer, but zombie prone. The banking system that emerges from the Cascade will be fundamentally different. Many banks will have failed or been merged out of existence. Deutsche Bank likely absorbed by a French or Italian bank as part of a European consolidation. Standard Chartered possibly nationalized or broken up. Several Chinese banks merged to hide losses. The survivors will be ultra-conservative. Capital requirements will be even higher. Risk-taking will be minimal. But this creates a problem. Banks will be too scared to lend. We'll see the Japan syndrome. Banks technically solvent but unwilling to extend credit to risky but potentially productive borrowers. Small businesses, startups, anyone without perfect credit will struggle to get financing. Zombie companies, firms that earn just enough to service debt, but not enough to grow or invest, will proliferate. Banks won't foreclose because realizing losses would hurt their capital ratios. Companies will survive in limbo, unable to grow, unable to fail. Economic growth will be anemic. Innovation will slow. The dynamism that drove growth for decades will be absent. Shadow banking will be heavily regulated, possibly restricted. Hedge funds will face leverage limits. Private equity will be required to hold more capital. This is probably good for stability, but bad for market efficiency and price discovery. Stock markets will be volatile and generally lower. The multiple expansion driven by low rates and QE will reverse. Price to earnings ratios will compress. Dividend paying value stocks will outperform growth stocks as they did in the 1970s. Bond markets will be fundamentally different. Investors will demand much higher yields for long-term bonds, fearing inflation. Yield curves will steepen dramatically. Short rates controlled by central banks, but long rates reflecting inflation fears. Some countries' bonds will be uninvestable. Dozens of emerging markets will be locked out of international capital markets for years. Even some developed nations might face challenges. Italy, Spain, possibly France. Dimension 2. Trade and globalization, fragmented regionalization. The era of hyperglobalization is over. Trade will not recover to pre-crisis levels for a decade or more. Here's why. Trade finance collapse. Letters of credit will be expensive and hard to obtain. Banks will only finance trade with the most creditworthy counterparties in the most stable countries. Supply chain rewiring. Companies will abandon just-in-time logistics in favor of redundancy and local sourcing. Manufacturing will reshore or nearshore. Efficiency will decline, costs will rise, but resilience will improve. Regional trade blocs. We'll see the formation of more rigid economic zones. North American bloc, US, Canada, Mexico, European bloc, EU consolidating, possibly shrinking. Asian bloc, China, ASEAN, possibly Korea and Japan. Regional blocs in Latin America, Africa, Middle East. Trade within blocs will recover. Trade between blocs will remain depressed. Strategic decoupling. The US-China economic relationship will shrink dramatically. Technology, capital, and even people will flow less freely between them. This decoupling will extend to their respective spheres of influence. The cost, global efficiency declines. The benefit, more resilient, less crisis-prone trade relationships. Container shipping volumes will be 20% to 30% below peak. Airlines will struggle with reduced business travel and cargo. Ports and logistics companies will see permanent capacity reduction. Dimension 3. Currencies and monetary system. The dollar survives, but despite everything, the US dollar will remain the primary global reserve currency. There's simply no alternative that can handle the volumes required for global trade and finance. The euro might not survive in its current form if the crisis splits the eurozone. The yuan? China's capital controls and lack of rule of law prevent it from being a true reserve currency. Bitcoin or crypto? Nowhere near stable or scalable enough. So the dollar persists by default, but its dominance will be weakened. We'll see the emergence of a multi-currency world. The dollar for 50% of trade and reserves, down from 60%. The euro for 20% if it survives. The yuan for 15%, up from 3%, primarily in Asia. Gold, SDRs, and basket currencies for 10%. Crypto and alternatives for 5%. Regional trade will increasingly settle in local currencies. China and Russia already do this. Others will follow. Currency volatility will be a permanent feature. Exchange rates will swing 10%, 15%, even 20% year to year. This makes trade planning difficult and increases hedging costs. Some countries will adopt full dollarization, officially using the US dollar instead of their own currency. Ecuador and El Salvador already do this. Others might follow after their currencies collapse. Inflation will be higher everywhere. Central banks will target 3% to 4% instead of 2%, implicitly accepting that lower rates are impossible given debt levels. Real inflation will often exceed targets. Dimension 4, geopolitics. More conflict, less cooperation. Financial crisis creates political instability. Political instability creates conflict. We should expect rising populism and nationalism. Governments will blame foreigners, immigrants, international institutions. Borders will harden. Increased authoritarianism. In times of crisis, voters often choose strong leaders promising simple solutions. Democratic backsliding will accelerate. Resource conflicts. With trade disrupted, countries will compete more aggressively for energy, food, minerals. Disputes over the South China Sea, Arctic resources, African minerals will intensify. Debt diplomacy breaking down. China's belt and road defaults will poison relationships with dozens of countries. Chinese influence will wane in regions where they were once dominant. Regional power shifts. The crisis will affect countries differently. Those with resources, food security, and less debt will gain relative power. Brazil, Indonesia, Saudi Arabia might emerge stronger. Those dependent on trade and finance, Singapore, UAE, Switzerland, might weaken. Military tensions. Financially stressed nations sometimes start conflicts to distract from domestic problems. The Taiwan Strait, Ukraine, Iran, North Korea, all flashpoints that could ignite during crisis. The optimistic view. Crisis forces cooperation when countries realize they'll all sink unless they work together. The realistic view. History shows crises usually increase conflict before forcing cooperation. The 1930s saw rising nationalism and eventually World War before the post-war international order emerged. Dimension 5. Social impact. Inequality, unrest, and transformation. The human cost of financial cascade is enormous. Unemployment. During the acute phase, unemployment in developed nations could hit 12% to 15%. Not as bad as the Great Depression, but far worse than 2008. In emerging markets, it could exceed 25%. Wealth destruction. Stock markets down 40% to 50% from peak. Real estate down 30% to 40%. Bonds losses for holders. Middle class retirement savings devastated. Inequality deepens. The wealthy have access to hedges, offshore assets, real estate. The middle class holds mostly financial assets that collapse. The working class loses jobs. Inequality will widen to historic extremes. Social unrest, protests, riots, political violence will increase. We're already seeing previews. The tax protests in Kenya, France's Gilets jaunes, farmers' protests across Europe. Multiply that by 10 during full crisis. Mental health crisis. Financial stress causes depression, anxiety, substance abuse, suicide. During the 2008 crisis, suicide rates increased significantly. This will be worse. Migration pressure. People flee failing economies seeking opportunity. But borders will be closing, not opening. Humanitarian disasters at borders, refugee camps, and sea crossings. But also transformation. Reevaluation of values. Material success becomes less important when everyone is struggling. Community, family, resilience become more valued. Political realignment. Old political coalitions shatter. New movements emerge. Some positive: green transition, universal basic income, debt jubilees. Some negative: nationalism, authoritarianism, scapegoating, generational change, millennials and Gen Z, having lived through 2008, COVID, and now this cascade, will have fundamentally different economic expectations and political demands than previous generations. Dimension 6. Corporate winners and losers. Some companies and sectors will be devastated. Others will thrive. Losers. Banks and financial services. Obviously. Airlines. Business travel collapses. Leisure travel remains depressed. Luxury goods. When everyone is poorer, luxury suffers. Retail, especially debt-heavy retailers, mall-based stores. Commercial real estate. Work from home plus recession equals empty offices. Automotive. Discretionary purchase delayed when money is tight. Emerging market focused multinationals. Companies that depend on growth in now collapsed markets. Winners. Discount retailers. Walmart, Dollar stores, budget brands thrive when people trade down. Essential services, utilities, basic telecommunications, waste management. Food and agriculture. People still need to eat. Food security becomes premium. Defense contractors. Increased military spending during geopolitical tension. Infrastructure. Government stimulus will focus on infrastructure. Energy, with caveats, depends on transition policies, but basic energy remains essential. Healthcare. Demographic aging continues regardless of crisis. Technology, selective. Enterprise software and efficiency tools thrive. Consumer tech struggles. AI and automation continue as businesses try to reduce labor costs. Dimension 7, the debt restructuring decade. For countries that defaulted, the path forward is long and painful. Sovereign debt restructuring typically takes 5 to 10 years. It involves negotiations with creditor committees, haircuts, reductions in what's owed, maturity extensions, conditionality from IMF and other lenders, legal disputes in international courts. During this period, countries are essentially locked out of capital markets. They must run primary surpluses. Tax revenue exceeds, spending excluding interest payments. This means brutal austerity. Greece's restructuring took from 2010 to 2018 and involved 50% haircuts on private debt. Unemployment hit 28%. Youth unemployment exceeded 50%. GDP fell 25%. It was economic depression. Now imagine that happening in 30 or 40 countries simultaneously. The sheer volume of restructuring will overwhelm the international financial system's capacity to handle it. There aren't enough IMF resources, enough experienced negotiators, enough legal frameworks. Some predict a global debt jubilee, coordinated forgiveness of debt. Sounds good, but who takes the losses? Banks that lent the money? Pension funds that bought the bonds? Taxpayers in creditor countries? There's no painless answer. The timeline of aftermath. Let me give you a rough timeline of what recovery looks like. Years 1 to 2, acute crisis. Defaults cascade. Banks fail or are bailed out. Central banks print massively. Unemployment spikes. Stock markets bottom. Social unrest peaks. Years 3 to 5, stabilization. Defaults complete, restructuring begins. Banking system consolidated but cautious. Inflation remains elevated. Unemployment starts declining slowly. New political leadership emerges. Trade begins recovering regionally. Years 6 to 10, slow recovery. Debt restructurings completed. Some emerging markets regain market access. Global trade recovering but fragmented. Inflation gradually declining. Banking system functional but smaller. Economic growth remains below pre-crisis trends. Years 10 plus, new normal. Financial system more regulated, less innovative. Globalization permanently reduced. Geopolitics more confrontational. Social contract renegotiated in many countries. Economic growth structurally lower. Inflation target implicitly higher. It took roughly 10 years to fully recover from 2008, though recovery was uneven. This cascade will take longer, probably 15 years before the global economy returns to pre-crisis trend growth. But here's the crucial point. We won't return to where we were. The post-Cascade world will be fundamentally different. Just as the post-2008 world was different and the post-1970s inflation world was different. Financial crises reset the system, sometimes for the better, often for the worse, but always permanently. So you understand the cascade. You see it coming. Now, the critical question: what can you do to protect yourself, your family, your business? I'm going to give you specific, actionable strategies across different levels: individual, business, institutional. Not all will apply to everyone, but everyone should find something relevant. For individuals, personal finance protection. Strategy 1: reduce debt aggressively. In a deflationary collapse, debt is deadly. You owe dollars that become more valuable while your income falls. But in the inflationary aftermath, debt gets inflated away. The problem: you don't know which phase will hit you hardest or how long each lasts. The conservative approach is to reduce debt now, especially variable rate debt. Priority order: 1. Credit cards and high interest debt, pay off completely. 2. Variable rate loans, pay down or refinance to fixed. 3. Fixed rate mortgage, depends on rate. If above 6%, maybe keep it as inflation hedge. Strategy 2: build cash reserves, but don't hoard cash long term. You need liquidity to survive the acute crisis phase. Job losses, business disruptions, unexpected expenses. Cash is king during chaos. Target: 12 months of expenses in cash or near cash. Yes, that's more than the standard 3 to 6 months. These aren't standard times, but don't hold it all in one bank. Spread across 2 to 3 institutions. Why? Bank failure risk and also FDIC insurance limits. $250,000 per deposit or per bank. Consider keeping some physical cash at home. Not huge amounts, but $2,000 to $5,000. ATMs might not work during banking panic. However, don't stay in cash long term. Inflation will destroy it. Cash is for liquidity and crisis survival, not wealth preservation. Strategy 3: diversify across asset classes and geographies. The worst mistake: being concentrated in one asset class or one country. A balanced crisis portfolio might look like 25% stocks, mostly large cap, dividend paying, essential sectors. 15% bonds, short duration, high quality, inflation protected. 20% real assets, real estate, commodities, infrastructure. 15% gold and precious metals. 10% alternatives, farmland, private credit, etc. 15% cash and near cash. Geographic diversification is crucial. Don't keep everything in your home country. Spread across US, Europe, Asia, emerging markets that are better positioned, Chile, Indonesia, maybe Vietnam. Strategy 4: real assets, tangible value. When financial assets collapse and currencies debase, real assets hold value. Real estate, productive real estate, not speculative. Rental properties with positive cash flow. Agricultural land. Warehouses. Avoid trophy properties and luxury condos. Commodities, oil, natural gas, copper, agricultural commodities. Can hold through ETFs, futures, or stocks of commodity producers. Precious metals. Gold is the classic crisis hedge. Should be 10 to 15% of portfolio. Some silver. Hold physically if possible, stored securely, or through trusted allocation services. Avoid paper gold. That's just a promise to deliver. Infrastructure. Toll roads, utilities, cell towers. Assets that generate cash flow from essential services. Strategy 5: skills and human capital. Your most important asset is yourself, your skills, knowledge, relationships. Invest in skills that remain valuable during crisis. Healthcare skills, always needed. Trades, plumbing, electrical, HVAC construction, food production, farming, gardening, technology, especially practical IT, cybersecurity, basic mechanical and repair skills, build networks and community. In crisis, who you know matters as much as what you own. Mutual aid networks, professional connections, community relationships all become crucial. Strategy 6, tax advantaged accounts and structures. Governments will need revenue desperately. Expect higher taxes on high income, wealth, possibly wealth taxes, capital gains, estates, maximize tax advantaged accounts, 401k, IRA, HSA, 529 plans. Contribute up to limits while the tax advantages still exist. Consider international tax structures if you have significant wealth. They'll be very careful about legality and compliance. For business corporate survival, Strategy 1, balance sheet fortress. Companies with strong balance sheets will survive and thrive by acquiring weakened competitors. Pay down debt, especially anything maturing in next 3 to 5 years. Build cash reserves. Target 18 to 24 months of operating expenses. Secure credit lines now while banks are still lending. Reduce capital intensity where possible. Strategy 2, supply chain resilience. Single source dependencies are deadly during trade disruptions. Diversify suppliers across geographies. Build inventory buffers for critical inputs. Nearshore or reshore critical production. Map entire supply chain to understand hidden dependencies. Strategy 3, customer and revenue diversification. Avoid concentration in vulnerable markets or sectors. Reduce exposure to emerging markets if you can't afford losses. Diversify customer base. No single customer above 15% of revenue. Add recession-resistant products or services. Build subscription or recurring revenue models. Strategy 4, cost structure flexibility. Fixed costs kill companies during revenue collapses. Convert fixed costs to variable where possible. Use contractors instead of employees for non-core functions. Rent instead of own non-critical assets. Negotiate flex clauses in major contracts. Strategy 5, scenario planning and early action. Most companies react too late. Winners anticipate. Develop scenarios. Mild recession, severe recession, financial crisis, stagflation. Define trigger points for each scenario. Pre-plan responses, which costs to cut, which assets to sell, which markets to exit. Empower management to act quickly when triggers hit. Don't wait for certainty. By the time crisis is obvious, it's too late to prepare. For institutions, systemic risk management. This is for pension funds, endowments, family offices, foundations, institutions with long-term mandates and fiduciary responsibilities. Strategy 1, liability-aware investing. Match asset duration to liability duration. If you need to pay pensions in 20 years, don't invest in assets you'll be forced to sell at crisis bottoms. Use liability-driven investing frameworks. Immunize near-term liabilities with high-quality bonds. Take risk only with assets backing long-term liabilities. Strategy 2, stress testing beyond normal. Regulators require stress tests, but they're usually too mild. 2008 type scenarios. Run your own severe stress tests. 50% equity decline. Multiple sovereign defaults. Counterparty failures. Liquidity crisis. Stagflation. High inflation plus negative growth. Understand how your portfolio performs and tail risks, not just standard deviations. Strategy 3. Counterparty risk management. Who owes you money? Can they pay in crisis? Limit exposure to any single counterparty. Favor centrally cleared derivatives over OTC. Stress test counterparty credit. Hold collateral where possible. Remember, in crisis, a contract is only as good as the counterparty's ability to honor it. Strategy 4. Liquidity planning. During crisis, liquid assets become invaluable. Illiquid assets become unsaleable at any reasonable price. Maintain meaningful liquid allocation, 20 to 30% in assets that can be sold within a week without significant price impact. Don't chase last basis points of return at the cost of liquidity. The ability to meet redemptions, margin calls, or take advantage of opportunities is worth the yield sacrifice. Strategy 5. Governance and decision making. Crisis requires fast decisions, but institutions are built for slow, deliberative processes. Pre-delegate authority for crisis response. Create small crisis committees that can meet daily if needed. Define clear decision rights. Practice crisis scenarios. Run tabletop exercises. When crisis hits, you'll be better prepared. Universal principles across all strategies. Several themes apply regardless of whether you're an individual, business, or institution. Principle 1. Cash is king in crisis, but trash in recovery. You need liquidity to survive the crisis, but holding cash during the inflationary recovery destroys wealth. The art is transitioning from cash to real assets at the right time. Principle 2. Debt is dangerous until it isn't. High debt is lethal during the deflationary crisis phase. But if you survive to the inflationary phase with fixed rate debt, it gets inflated away. Debtors win, creditors lose. The question is survival. Can you service debt through the crisis? Principle 3. Diversification within reason. Diversification reduces risk, but also reduces returns. Over-diversification means you'll survive, but never thrive. The right balance. Diversified enough to avoid catastrophic loss in any scenario. Concentrated enough to benefit significantly from whatever works. Principle 4. Optionality has value. Keep options open. Don't commit everything to a single strategy. Maintain flexibility to shift as conditions change. The Cascade will evolve in unpredictable ways. Rigid plans will fail. Adaptability will succeed. Principle 5. Know thyself. Your risk tolerance, time horizon, psychological makeup matter more than optimal theory. If you can't sleep at night with a risky portfolio, de-risk even if it's theoretically suboptimal. If stress will cause you to sell at bottoms, better to be more conservative from start. Better to have a suboptimal strategy you can stick with than an optimal strategy you'll abandon in panic. We're nearing the end of our journey through the $300 trillion debt bomb. You understand the scale, the mechanisms, the vulnerabilities, the likely aftermath, and how to protect yourself. Now let me address the questions you're probably asking. When? How certain? And what should I do right now? The timeline. When does this happen? Predicting exact timing of financial crises is impossible. Anyone who claims otherwise is lying or deluded. But we can estimate probability windows. Based on debt maturity schedules, reserve levels, political calendars, and stress indicators, here's my assessment. Next 12 months, through end of 2025, 35% probability of Cascade trigger. Why relatively low? Governments and central banks are still functioning. No major emerging market has formally defaulted yet, though several are in distress. Banks are wounded, but not failing. The trigger would likely be a major unexpected shock, a geopolitical event, a major bank failure, or a sovereign default larger than expected. 12-24 months out, 2026, 50% probability. This is peak danger period. Debt refinancing needs peak. Political transitions in multiple countries. Central banks are stuck between inflation and financial stability. The system is maximally stressed. Even absent a major shock, the weight of debt becomes unsustainable during this window. 24-36 months out, 2027 70% cumulative probability. If we make it to 2027 without crisis, I'll be shocked. The structural imbalances are too severe. Something will break. Beyond 36 months. 85% plus cumulative probability. Essentially certain within 5 years, unless there's major debt restructuring, write-offs, or some solution that doesn't currently seem politically possible. What might prevent or delay it? Several scenarios could push the crisis out. Scenario 1. Miraculous growth. If global growth suddenly accelerates to 5% plus sustainably, debt to GDP ratios improve through growth rather than default. Tax revenues increase, making debt serviceable. Probability 5%. Where would this growth come from? AI revolution? Productivity miracle? Possible, but unlikely enough to be transformative quickly enough. Scenario 2. Coordinated debt restructuring. G20 agrees to voluntary debt reduction, particularly for poorest countries. China forgives some belt and road debt. Private creditors take haircuts in orderly fashion. Probability 10%. Politically difficult because someone has to take losses. Who? Also, this might only delay rather than prevent Cascade if it's not comprehensive enough. Scenario 3. Financial repression. Governments and central banks impose capital controls, force banks and pension funds to buy government bonds at artificially low yields, essentially taxing savers to reduce debt burden. Probability 30%. This might happen, but it's not really prevention. It's controlled slow motion crisis rather than acute crisis. You still get wealth destruction, just slower. Scenario 4. Inflation solves it. Sustained high inflation, 7 to 10%, for a decade reduces real value of debt. Governments service nominal obligations, but pay back in devalued currency. Probability 40%. This is actually likely to be attempted, but it requires threading a needle. High enough inflation to reduce debt, but not so high it spirals into hyperinflation. Most countries fail at this threading. Scenario 5. Technological deflation. AI and automation reduce costs so dramatically that it offsets other inflationary pressures. Living standards don't fall despite financial stress. Probability 15%. Technology might help, but won't prevent financial cascade, just mitigate human suffering during it. Bottom line probability. Combining all factors, my assessment, 80% probability of major global financial cascade within 5 years. That's not certainty, but it's high enough that you must prepare. For context, forecasters estimated 20 to 30% probability of 2008 crisis a year before it happened. Those who prepared for low probability, high impact events protected themselves. The certainty trap. Many people make a mistake. They wait for certainty before acting. I'll prepare when it's clear the crisis is here. But by the time it's certain, it's too late. Banks have already failed. Markets have already crashed. Capital controls are already in place. Preparation must happen during uncertainty. That's what makes it preparation rather than reaction. Think of it like earthquake preparedness in California. You don't know when the big one will hit. Could be tomorrow, could be 30 years. But you prepare anyway. Emergency supplies, earthquake insurance, structural reinforcement. Because when it hits, it'll be too late. The signal to noise problem. We live in an era of constant crisis warnings. Every week, someone is predicting imminent collapse. This creates noise that drowns out real signals. How do you distinguish real crisis from noise? Look for confluence. One indicator means little. Multiple indicators flashing simultaneously means something real is happening. Watch what smart money does, not what it says. Hedge funds talk their book. But track their actual positions if you can. When they're hedging aggressively, they're genuinely worried. Trust institutions with skin in the game. When central banks take emergency action, they're seeing something serious in their private data. Recognize acceleration. Financial crises don't develop linearly. They accelerate. When indicators that were changing slowly start changing fast, that's your signal. Right now, what you should do this week. I'm going to give you a concrete action plan for the next 7 days. Day 1, today. Assess your current situation. Calculate total debt. List all financial accounts and balances. Identify concentrated risks, single employer, single asset class, single geography. Date 2, emergency cash. Ensure you have at least $1,000 cash at home. Verify you have FDIC coverage within limits across banks. Start building toward 12-month emergency fund if you don't have it. Day 3, debt strategy. List all debts by interest rate. Create payoff plan prioritizing highest rate debt. Consider refinancing variable rate debt to fixed. Day 4, portfolio review. Check asset allocation. Identify concentration risks. Research recession-resistant stocks and real assets. Day 5, insurance and protection. Review life, health, disability, property insurance. Ensure adequate coverage. Consider umbrella liability policy. Day 6, skills and community. Identify valuable skills you have or need to develop. Reach out to key relationships. Research local community resources. Day 7, monitor and plan. Set up alerts for key indicators. Create scenarios and responses. Schedule quarterly reviews to reassess. This isn't comprehensive preparation. That takes months. But it's a start, and starting is what matters. The psychological challenge. The hardest part isn't the financial preparation, it's the psychological burden of seeing it coming. You'll be tempted to dismiss it. Maybe I'm wrong. Maybe it won't happen. Maybe it won't be that bad. You'll face skepticism from others. Why are you worried? Everything seems fine. You're being paranoid. You'll struggle with how much to prepare. Should I sell everything and buy gold? Should I keep living normally? Here's my advice. Prepare enough to sleep at night, but not so much that you can't live today. The goal isn't to profit from crisis, though some will. The goal is to survive and position yourself to help others and rebuild afterward. The bigger picture, why this matters. This isn't just about money. The $300 trillion debt bomb represents the culmination of 50 years of financial engineering, globalization, and the belief that we could borrow our way to prosperity indefinitely. We can't. The Cascade, when it comes, will force a reckoning. We'll have to answer fundamental questions. What is the purpose of finance? To serve the real economy or to perpetuate itself? How much inequality can a society sustain before it breaks? Can democracy survive repeated financial crises? What obligations do nations have to each other in an interconnected world? How do we balance growth, stability, and sustainability? The answers we give to these questions will shape the next 50 years. Some will see the cascade as the end. I see it as a necessary reset. Painful, yes, but potentially the foundation for a better system. The financial system we have is fundamentally flawed. It creates massive instability, rewards short term thinking, punishes savers, and enriches financial engineering over productive enterprise. When it collapses, we'll have an opportunity, brief but real, to build something better. Maybe we'll seize that opportunity. More likely, we'll rebuild something similar to what failed, just slightly reformed. That's what happened after 2008. But there's a chance, a small chance, that this time we'll do better. Final thoughts. Living in the shadow of the cascade. As we close, I want to leave you with perspective. Throughout history, humans have faced existential economic challenges. The South Sea bubble, the panic of 1873, the Great Depression, the stagflation of the 1970s, the 2008 crisis. Each time, people thought it was the end. Each time, we survived and eventually rebuilt. We'll survive this too. Not everyone, not without pain, but collectively, humanity will endure. The question isn't whether we survive, it's how we survive and what kind of world we build afterward. Financial crises are terrible for those who experience them. Jobs lost, savings destroyed, dreams deferred. Real human suffering that lasts years. But they also create opportunity. Entrenched interests lose power. Failed ideas are discredited. Space opens for new thinking. The Great Depression gave us Social Security, financial regulation, and the modern economic toolkit. The 1970 stagflation gave us new understanding of monetary policy. 2008 gave us fintech and cryptocurrency. What will this cascade give us? I don't know, but I'm certain that on the other side, things will be different. Your role in what comes next. You're not a passive observer. You have agency in three ways. First, your personal preparation. Everything we discussed, debt reduction, portfolio diversification, skill building. These aren't just defensive. They're offensive. They position you to survive the crisis and help others. To maybe buy assets at distressed prices. To start businesses in a recovery. To be part of the solution. Second, your voice. The political decisions made during and after crisis will shape generations. Speak up for policies that seem fair and sustainable. Push back against policies that protect the powerful at the expense of everyone else. Your voice matters, especially during crisis when everything is in flux. Third, your community. Financial crises atomize society. Everyone focused on their own survival. But the communities that thrive are those that stick together. Mutual aid, skill sharing, collective action. Be someone others can count on. Build relationships now that will matter when times are hard. The paradox of doom. Here's a strange paradox. The more people who prepare for crisis, the less severe the crisis might be. If everyone reduced debt, built savings, and diversified portfolios, the financial system would be more resilient. There would be fewer forced sellers during crisis, less contagion, faster recovery. By warning about disaster, we might help prevent it, or at least make it less terrible. That's a paradox I'm comfortable with. I'd rather be wrong about the cascade and look foolish than be right and watch the world burn. One more indicator. This broadcast. The fact that you're listening to a 2-hour deep dive into global financial cascade risk is itself a signal. In normal times, this would be fringe content. But we're not in normal times. More people are sensing something is wrong, even if they can't articulate what. That collective sense of unease, that's worth paying attention to. Markets are made of collective human psychology. When anxiety becomes widespread, it becomes self-fulfilling. So yes, the fact that this content exists and finds an audience is itself confirming the thesis. We're in the pre-crisis awareness phase, where enough people see the risks that they start preparing, which changes behavior, which affects markets. Signing off. We've covered enormous ground in the past 2 hours. The $300 trillion debt bomb and how we got here. The Cascade model showing how it will spread from emerging markets to China, to Europe, to America. The specific banks and institutions most at risk. The 7 mechanisms of contagion. The indicators to watch. Why policy responses will fail. What the aftermath looks like. How to protect yourself. You now know more about this crisis than 99% of people. You have tools to prepare, metrics to monitor, and strategies to protect yourself and those you care about. What you do with this knowledge is up to you. You can dismiss it, go back to normal life, hope it doesn't happen. That's one choice. You can panic, sell everything, buy gold and king goods, move to a bunker. That's another choice, probably an overreaction. Or you can do what I recommend. Take it seriously, but stay balanced. Prepare prudently. Monitor actively. Live your life, but with awareness and readiness. The cascade is coming. Probably not tomorrow, probably not exactly as predicted, but it's coming. The math doesn't work otherwise. When it arrives, those who prepared will fare better than those who didn't. Not just financially, psychologically. There's enormous peace in knowing you saw it coming, prepared as much as possible, and positioned yourself to endure. So prepare. Stay informed. Take care of your people. And remember, after every crash comes a rebuilding. Be ready to be part of that rebuilding. This has been the $300 trillion debt bomb, predicting the global default cascade. Stay safe. Stay informed. Stay prepared. Sound fades to silence. Distant clock ticking one last time. Hashtag, hashtag, hashtag appendix. Resources for continued monitoring. Free data sources asterisk. Fred, Federal Reserve Economic Data Fred.stlouisfed.org. Bank for International Settlements. BIS.org. TradingEconomics.com. Investing.com. Central bank websites. Fed, ECB, BOE, BOJ. Paid/professional sources asterisk. Bloomberg Terminal. Reuters Icon. Financial Times. The Economist. Wall Street Journal. Books for Deeper Understanding asterisk. This Time is Different by Reinhardt and Raghav. Manias, Panics, and Crashes by Kindleberger. The Price of Time by Edward Chancellor. The Fourth Turning by Strauss and Howe. When Money Dies by Adam Ferguson. Key Metrics to Track Weekly asterisk. Emerging Market Bond Yields. Bank Stock Prices. Credit Default Swap Spreads. Currency Exchange Rates. SOFR/Euribor Rates. Financial Stress Indices. Set up Google alerts for sovereign default, bank failure, currency crisis, IMF bailout. Follow on Twitter/X. Central bank accounts, financial journalists, macro analysts. Final note asterisk. This script represents analysis and opinion based on publicly available data and historical patterns. It is not financial advice. Consult qualified professionals for personal financial decisions. The future is inherently uncertain. Prepare, but also live.